Hi there, Mr. Holcomb here with another episode of The Math Behind the Modules. Okay, this is chapter 3.1, Introduction to Consumer Credit. The objectives for this lesson are define basic credit terms. There's a lot of them. Identify types of lending institutions and compute finance charges for installment purchases. All right, so let's start off by going over the definitions. And the first one is credit. So there's two ways to buy something: buy now, pay now, or buy now, pay later. And if you buy now and pay later, that is on credit. So if you use a credit card, or even if you use electricity, if you have an electric bill, you turn a light on January 5th. You don't pay for it till the end of the month and the statement comes out. So you have credit. You're using electricity and paying for it later. So that's also credit. Okay. A person who uses credit cards or takes out loans is also using credit, and anyone who extends credit to a consumer is called a creditor. And a debtor is a person who uses credit. So credit is buy now, pay later. A debtor who is someone who buys now and pays later. And a creditor is someone who gives you something now and accepts money later, if that makes sense. So those three go kind of hand in hand. And continuing on to assets, everything you own is an asset. Your house, your car, your guitar. Okay, everything you own. And the reason I said that's because example one talks about guitars. Okay, so that's assets. Earning power is your ability to earn money now and in the future. Whenever you apply for a loan, they will ask you, what is your annual income? That's your earning power. Credit rating is your report card basically on your credit history. You get graded. If you pay everything off on time, you get a higher credit score. If you have multiple credit companies allowing you to have credit, if you have more, it's actually kind of interesting that the more credit you are offered from different companies, the more credit, the more you can charge, the more opportunities you have to charge increases the number of people who lend you money. For example, if I have one credit card, or then I go out and I get 2 or 3 more, and I have 4 credit cards, and I have, say, $5,000 credit limit on all of those, instead of one card at $5,000 credit limit, you have 4 cards with $5,000 of credit limit. That'd be $20,000 of credit. So that is actually good for your credit score, so long as you keep your percentage of your charges on your cards low. All right, the more you have on your card, the lower your credit score is, and you pay it off, and then the credit score comes back up, that kind of thing. All right, so that's your credit rating. A credit reporting agency is a company who keeps track of everything: how much you make, how much you spend, how frequently you spend. If you apply for a loan, they will do a check, and those checks are called hard inquiries. And a hard inquiry will lower your credit score temporarily, and then they come off, and then your score comes back up as well. So we'll be getting into all of that. Your FICO score. So FICO, I've heard of FICO, but I had never known where the name came from until I read this chapter, and it is from the name of its creator, and it's Fair, Isaac and Company. So 2 people, last name Fair and Isaac, I'm assuming, and that came up with FICO, Fair Isaac Company score. Kind of like Geico Insurance Company, government employee insurance companies, where Geico came from. So FICO is Fair Isaac and Company. So that company takes into consideration everything that you have charged, how you've paid, all that, come up with a score. And it can be anywhere from usually 300 to 850. I've even seen some of them reporting as high as 900. Okay, so that's FICO score. Installment plan. Some stores offer credit-worthy customers the convenience of paying for merchandise or services over a period of time. That is an installment plan. So that's a store credit. Okay, and then the down payment is, okay, how much you put down on something. So for instance, I just recently purchased a truck, and I put $2,500 down so that they start the building process because it's a new truck. So it's going to go to manufacture. And so I put $2,500 down. So that's my down payment. And that gives you the opportunity to have an order in place so that they can build it. Otherwise, they won't do it. Okay, so your down payment and a deferred payment plan. Let's see, how can I explain that? Okay, so a deferred payment plan is probably like taking out a loan with no interest. Okay, so if you go into the store and you purchase something and they say, if you pay it off in 6 months, there will be no interest. So you make payments, and as long as you pay it off by the date that they say, then there will be no interest charge. So that's called a deferred payment plan. A layaway plan, I don't even know if they still do this anymore, but stores back in the day when I was a kid, which was like a really long time ago. Yeah. Layaway plan. So you go into Woolworths. Look, that store's out of business now. And, oh, I want this thing here. So I'll bring it over to this counter. I'll give it to them and I'll give them $10 cash and they will put it on a shelf for me. And they'll label it that it's mine. And then when I come in and I make payments to it, they take the money. And then as soon as it's fully paid for, they give me the product. So it's kind of like, okay, you can't save on your own. How about we do that for you? And we will hold this for you. And a layaway plan could actually help you get something that could be in high demand, something that comes off the shelf quickly, like toilet paper during COVID. You could put toilet paper on layaway and they would save it for you. Should have done that. All right. And default, that's the bad word in here. But if you default means you didn't live up to your expectations of your credit. So you borrowed, you charged your credit card, you didn't make the payments on time, you're behind so far that you go into what's called default. Okay, don't do that. That'll kill your credit score. And so default is not owning up to your expectations of repay. Okay, example 1. Heather wants to purchase an electric guitar. The price of the guitar with tax is $2,240. Okay, there's the cost of the guitar with tax. If she can save $90 per month, how long will it take her to save up for the guitar? So $2,240 guitar. Okay, 2240. So you take the price of the guitar divided by $90, and that would take 24.8889 months. So that's all we do is we take the amount of the item, obviously, divide it by how many dollars per month, and that is going to equal the number of months. And what was it? 24.88. So let's just say approximately 25 months. Okay, so this would be a perfect example of putting something on credit. If you don't have a guitar and you want to start playing guitar, do you start saving and say, okay, I'm going to start playing guitar in 2 years and 1 month? Or do you buy a guitar on credit and make payments and pay a little bit more for the guitar with the interest, but practice the guitar and you'd be really good at guitar in 25 months instead of just starting? So that's one really good example of where credit might be the better choice than saving. So if Heather's guitar costs, now we're going to do the check your understanding. If Heather's guitar costs X dollars, she can save Y dollars per month. So here, the cost of the guitar was this. So that's my numerator. And the amount she saved per month was $90, and now it's Y. Express algebraically the number of months it would take Heather to save for the guitar. Well, there it is. X dollars divided by Y months. It's pretty basic and straightforward. Okay, example 2 says, Heather from example 1 speaks to the salesperson at the music store. who suggests that she buy the guitar on what is this doing? On an installment plan. It requires a 15% down payment. The remainder plus a finance charge interest is paid back on a monthly basis for the next 2 years. The monthly payment is $88.75. What is the finance charge? So if I go back, the guitar was $2,240. So that's where we start. The price of the guitar. So I want to find out what 15% is first. So we take $2,240, verify, 2240 times 15%, which is 0.15, equals, and let's see, that'd be 224 plus 112, but let's just do it this way. 2240 times 0.15 is $336 down. Okay, so she's making a down payment of $336. So if I subtract that $336 from the cost of the guitar, I'm going to get $1,904 remaining. So I need to finance that. And the monthly payment's $88.75 for 2 years. So I'm going to find out how much money that is. It's 24 months. So it's $88.75 times 24. And that will be a total of $2,130. Okay, so this is the total she paid with interest, $2,130. But the guitar was only $1,904 after the down payment. So here's how you determine that. You subtract what the guitar costs from what you paid, because that includes the interest, and the difference is the interest. And it is that right? $226. $2,130 minus $1,904 is $226 interest. Okay, $226 of interest on the guitar. So that would mean that she, at the end of the 2 years, would have actually paid $2,466 for the guitar. All right, so she's paying $226 for the opportunity to play the guitar 2 years sooner. All right, now it says check your understanding. Assume the original price of the guitar was P dollars, and Heather made 20% down payment for 1 year installment purchases. The monthly payment was W dollars. Express the charge, the finance charge, algebraically. Okay, so for starters, W is dollars, and this is 1 year. So how many months are in a year? 12. So that'd be 12 times W is the monthly payment, and how many months? 12 times W dollars. And we're going to subtract so what did we do here? We found out how much the guitar was after paying a certain amount down, and then we subtracted that from what we paid. So here's what we're going to pay, W dollars for a year, and then we're going to subtract, and this is how much we put down. So the remainder, if we put 15% down, we're actually paying for 85%. We still have 85% we owe. In this case, we're paying 20% down. So we still owe 80%. So this is going to be minus the 80% of the price of the guitar P. That makes sense. Okay. Number of months times the dollars minus 80% of what we're borrowing because we paid 20% down. So this is the algebraic expression, 12W minus 80% of P. Okay, example 3. Carpet King is trying to increase sales. and it has instituted a new promotion. All purchases can be paid on the installment plan with no interest. Okay, so they're trying to get people in their door and buying something. So it puts someone into a purchase, and it gives them an obligation to pay, and they have to pay the total within 6 months. If they don't, then they'd probably charge interest after that. So that's how they get the sale, get people hooked, if you will. And it's an incentive. There is a $20 minimum monthly payment required. So if we have a family called the Schuster family, and they buy carpet for $2,134 and make only minimum payments for 5 months. Okay, so this amount right here is irrelevant in this calculation. Okay, it does not matter what they paid. All they're telling us is they paid the minimum for 5 months. How much will they have to pay in the 6 months? Okay. How much will they have to pay in the 6th month? Oh, I see. Okay. Yes, it does matter. All right. So here's what we're going to do. First, let's find out how much they paid. So the first thing is 5 months. So I could set this up algebraically just for practice. $20 per month is the expression. So they're paying $20 per month, and they paid that $20 for 5 months. So they've actually paid $100. Okay. So the minimum payment was $20 a month, interest free, up to the first 5 months. How much will they have to pay in the 6th month to avoid interest? So now what we have to do is we have to take this $2,100, oops, not 21,000, $2,134, subtract the $100, and they still owe $2,034 that they would have to pay in the 6th month to avoid defaulting on this no interest. Okay, if they paid this amount, the carpet's paid off, and they didn't have to pay interest. $2,034 in the 6th month. Okay, the Whitendale family purchases a new refrigerator on a no interest for 1 year plan. The cost of the refrigerator is $1,385, and there is no down payment. If they make a monthly payment of X dollars until the last month, express their last month's payment algebraically. Okay, so all we have to do now is model the last example. No interest for 1 year plan, and the cost is $1,385. And so we need to know how many months and how much they're paying per month. If they make a monthly payment of X dollars, so that's X dollars until the last month. So 12 months in a year, until the last month would be 11. So that is going to be 11X, 11 months times the amount per month. So there's 11X. So that's just like this 20M. We don't know what X is, and we're not going to calculate that this time. So then what did we do? We took the cost, okay, purchased a new refrigerator for $1,385. So in this case, what did we do here? We took 2,134 and subtracted 20M, which was 100. So we're going to take this 1,385 and subtract 11X. So the answer is $1,385 minus 11 months times X number of dollars. And that's how much they'll have to pay in the 12th month to pay it off. Okay, oh Cecilia, that's a Simon and Garfunkel song, purchased $4,322 worth of home appliances on Appliance Depot's deferred payment plan. The plan allows the customer to make no down payments. Let's highlight some of this stuff. So no down payment required. Purchasing a $4,322 worth of home appliances. And there is no payment at all for 3 months. Okay, so a lot of places will do that. They'll give you a 3-month break. You have it, you use it for 3 months. You're not making payments on it. If the entire $4,322 is paid in full before the 3 months is up, there is no interest. This is a store's way to persuade customers to make purchases. If it is not paid in full within the 3 months, then there is a finance charge APR, annual percentage rate of 2000 or 21.6% applied monthly, going back to the first month. Okay, so it's retro, it goes back to the first month. So if Cecilia makes the full payment a week after the 3 months expired, what is the finance charge? Okay, so the first thing we're going to do is find the monthly interest charge. So we have an annual interest charge. So we want to take that 21.6%. Whoops. Oh, if I wrote what I said, 21.6%, and we're going to divide that by 12. So if I take 21.6 divided by 12, that would be 1.8%, which equals 0.018. There's our interest rate for 1 month. So once we've done that, we want to find the interest. It says we want to find the interest after the first month. So we're going to multiply $4,332. That's step 2. Then you take the amount, $4,322, and multiply that by 0.018. Okay, so now I'm going to take this 0.018. So let me just do 4,322 times 0.018, and that is $77.80 roughly. Approximately, that's an approximation. Okay, so $77.80 rounded to nearest penny. So then we want to find the balance after the first month by adding the interest to the balance. So we take that 4,300, next step is take that $4,322, add the $77.80 in interest, and the total is going to be $4,399, okay, and 80 cents. The balance for the second month would then be this amount before computing the second month's interest. So then we have to compute the second month's interest by using this total. So now we're going to take 4,399 because it's interest on that total. And we're going to multiply that by 0.018. And so when I take $4,399.80 times 0.018, 4,399.80 times 0.018, not 0.18, and hit enter, it's $79.19.6, and that's $79.20. That would be an approximation of $79.20. So then we take that 4,399.80 and add the $79.20, which is the interest for the second month. And that is going to be $4,479. So the third month's balance is $4,479 before interest is computed. And then one more time, we're going to take that $4,479, multiply it by 0.018 to get how much interest we paid on the third month. So it's 4,479 times 0.018, and that comes out to be $80.62. Approximately, I rounded down because the next one was 0.2. So that was $80.62. So the amount due the week after the third month offer expires would be the sum of $44.79 plus 80.62. So my final answer would be $4,479 plus 80.62. And that would be 2, 6, 9, 15, carry the 1, 5, 4. So it would be $4,559.62. So you take that 4,000. So it says if Cecilia makes a full payment a week after the 3 months expired, what is the finance charge? Here's what she paid. Here's what the original price was. The difference is the finance charge. So you take $4,559.62 and subtract $4,322. And the finance charge is 9 minus 2 is 7, 5 minus 2 is 3, 5 minus 3 is 2. There was a $237.62 finance charge over those 3 months. All right, now to check your understanding is a bit of a review from chapter 2. All right, so here's what we're going to do. It says, if Cecilia's plan was a 2-year deferred, 2-year payment plan, and she paid it a week late after 2 years, would her total interest be more or less than $1,800? Explain. Now remember, the formula for interest, compound interest, is you take your balance B equals your principal times 1 plus your interest rate divided by number of times term to the power of NT, where B equals balance. When we're done, P equals principal. R equals interest rate. N equals the number of payments, the number of times. So I'll just put number, and T equals time. So when I substitute this in, it's going to be B equals the principal, which was $4,322. Okay, times 1 plus the interest rate of 0.0216, not 0.216, 21.6%, 0.216 divided by monthly is 12 months in a year to the power of 12 months in a year, our number of times our number of years 2. So when I put that in the calculator, 4,322 parentheses 1 plus another parentheses for the fraction, 0.216 divided by 12, close the parentheses to that fraction, close parentheses to the 1 plus fraction, and it's to the power of n times t. Enter, and I got $631.80. So my B is 6,631.80. Okay, so when I do that, 6,631.80 minus the principal of 4,322. Okay, minus 4,322.00. And the interest I paid, this would be a 2, 11 minus 2 is 9,032. They would have paid $2,309.80. So would the total interest be more or less than $1,800? It is definitely more. And the explanation is right there. Okay, remembering your interest formulas from chapter 2. Okay, example 5. Circuit Town is having a huge sale on large screen TVs. Circuit Town. Anita purchased a 60-inch curved screen TV for $2,045.15. That included the sales tax. This purchase was made on a 6-month layaway plan. She had to pay the monthly payment of $361. What is the sum of the monthly payments? It's the first question. So we're going to take $361 times 6, and it's $2,166. So the sum of the monthly payments was $2,166. Simple enough. And then it says, what was the fee charged for the layaway plan? So $2,045.15 was the cost of the TV. You subtract that from the $2,166 that you paid, and that will give us our balance. So I have to borrow from here, and that makes that a 9, and a 10 minus 5 is 5, 9 minus 1 is 8, 0, 2, 1. So the fee for laying it away was $120.85, but huge sale on large screen TVs. So they don't say what the sale was, but if it was a large percentage and this amount here was less than what you saved, you would lock in the sale price, even though the sale might be over by the time you buy the TV. Make sense? So sometimes laying it away, putting it in layaway is going to preserve the sale price. So even if there is a fee for putting it on layaway, it may be better to do that. Okay, now it says check your understanding. Marty is making a layaway purchase of $1,500. Let me get my highlighter back. A $1,500 couch at Frank's Furniture Store. He will be paying $156 every 2 weeks for 20 weeks on a layaway plan. What's a layaway fee purchase? What's the layaway fee for the purchase? Okay, so first of all, let's see how much you paid. 2 weeks. Every 2 weeks for 20 weeks, well, that would be 10 payments, yes? So $156 every 2 weeks for 20 weeks would be 10 payments. So multiply that by 10, it's $1,560. The couch was $1,500. So you take $1,560, subtract the cost of the couch, the price of the couch, I mean, and the $60 over is the layaway fee for this purchase. Okay, so it cost him $60 to put it on layaway. All right, hopefully that all made sense to you. That is the end of chapter 3.1. Thanks for watching and have a great day.